Hey, Dan Passarelli here. How are you today? We have got great stuff to talk about here today. We're talking about some really expert trade management in adjusting time spreads. If you trade time spreads, you are going to like what we're going to talk about right now. Now, before we go any further, I need to make sure you can hear me. So please head on over to the questions box, the Q&A box, and please let me know that you can hear me. Just give me a big yes if you can hear me. Thank you, Joe. Much appreciated. Excellent, excellent, excellent. Thank you, Dennis. Very appreciated. Thank you, Marie. Great to see you today. Excellent. That is really great. All right. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by emailing investor services at theocc.com. Also, don't trade with money you're not prepared to lose. And what we're doing here is providing generalized information. This is not specific to your needs or goals or risk tolerance or a situation because I don't have that personal relationship with you at this time. But let's get a little closer here, shall we? If you're new to these Firstrade webinars, well, first of all, what are you doing? You should be watching these every week, every Tuesday at the same time, noon Eastern time. But if this is your first time, hopefully you join us next Tuesday and forever and ever and ever. Because here's who I am. I am Dan Passarelli, and I'm an author of two of the most popular option trading books, Trading Option Greeks and The Market Taker's Edge. And I am a trader. I started trading professionally back, oh, geez, I don't want to, date myself here or embarrass myself telling you how old I am, but I've been doing this for a long, long time. Started down on the trading floor in 1993. Oh my goodness, I know I'm old. Look at all that gray hair. And now I trade in a regular retail account just like you. And I am the founder of Market Taker Mentoring, which is the leading option trader education company in the world. And I am a trading industry collaborator. I work with a lot of really good firms out there, like Firstrade, for example, some other brokers, also for many, pretty much all of the options exchanges in the world, actually, at one point or another. And I'm also a family person. I have my wife, Kathleen, who those of you who are current market taker student traders are familiar with, and my two adult children. And besides trading, I do other things for fun. You've got to count trading as something fun, right? But I'm also a runner, a foodie. I love trying different foods and such, traveling, been all over the world, and also musician. I enjoy music, playing it, listening to it, etc. Now, do you know how much I want you to enjoy what I do here today and how much I want to encourage you to come back? I'm going to shamelessly bribe you with more free education and other option trader resources. If you go to my website, which is markettaker.com, market like stock market, taker like take what's rightfully yours, two T's in a row, markettaker.com, and just simply go to the top right up here and click on join free. There's lots of great resources from ebooks to free video classes to special discounts on things. And oh boy, what else even? Oh, lots of other things. Access to our chat room. So please go ahead and do that. Also, Here's what we're going to talk about today. Quick review on time spreads, how to roll time spreads, how to leg into a double calendar, and how to adjust a double calendar. Like I said, this is the more advanced type stuff. So if you're not familiar with time spreads, which are also called calendar spreads, some people will even call them horizontal spreads. If you're not familiar with them, it's actually really, really simple. It's when a trader buys one option and then sells another that's the same type. So they're either both calls or both puts, and they have the same strike price, but different expirations. Now, a long time spread, like long means buy or own, okay? Um, a long time spread is when we buy the option with more time until expiration. Because if they have the same strike price, the one that has more time is going to cost more. So it's a debit transaction. So therefore, we're long the spread. Short time spread is just the opposite. That's selling the longer term one. Now, retail traders, which is what you and I are referred to by exchanges and brokers and that kind of thing, which basically just means non-professional traders. We typically buy time spreads. Why? Well, because the margin is a lot higher for short time spreads, because there's a lot more risk for short time spreads, and the risk reward really isn't that great. If you are thinking about a short time spread, you're probably better off buying a straddle or something like that. So we're going to keep our conversation to the much more practical version, the long time spread. So let's take a look at a typical time spread. Okay. We're going to go here to our Firstrade account. Put options. And let's just look at something like, oh, I don't know. How about how about Bank of America? And we'll pull up the option chain. Now, what we could do is, instead of just looking at this as calls and puts, is we can look at it as just simply a calendar spread. We can choose calendar call spread or calendar put spread. So let's look at the calendar call spreads. Okay, so here is how this works. So if we have got the 45, okay, so this is the strike price here of the January and the February. Because remember, they share the same strike price, right? So if we wanted to buy, maybe let's say what we typically do is we do like an at the money spread. Now, Bank of America here is at 46.75. So what's the at the money? Well, it's either 46.50 or 47, right? We're kind of between those two. So we pick one. What I like to do is I like to typically pick the out of the money version of that, which in this case would be the 47 strike. Or, another thing that I do is because with the profit and loss diagram that we'll take a look at in a second, if I have even a little bit of a bias, I'll choose my strike price around there, because whatever strike price we choose is where we expect the stock to be trading around expiration. So if we look here at, say, the 47 calls, on the left side is the January 31st expiration. We could sell those at 34. And we're looking here at the February 7th right now. And we could buy those at 63 cents. So 63 minus 34 is what? 29 cents, which is why it shows 29 cents right here. And we could just simply click on that and, trade it. Now let's get back to this option chain. The January 31st, for those of you who are watching this live, those expire in, well, less than 4 days. So that's a pretty short-term trade. Now, that's okay. I'm okay making those shorter-term trades. And in fact, there can be some advantages to those shorter-term trades. One of them being that a time spread involves buying one option and selling a shorter-term option. And we usually do these near the money. So we have to think back on the Greeks class that I did. When did I do the Greeks class? Oh gosh, that was over a month ago. I did the Greeks class here with Firstrade. Go back on the Firstrade's YouTube channel and review that one, please. You're going to get a lot out of that. But shorter term near the money options have higher thetas. So we can make more if we sell a shorter term option. But maybe instead we want to do the February 7th expiration as a short-term option. Well, we've got the February 7th options over here. We've got the February 14th options over here. And so we could look at them by, okay, I want to sell the shorter term one, buy the longer term one, and do the math, just subtract it, right? Buy these at 84, sell these at 63, that's 21 cents. Or we can just simply use the offer that is right here. All right, so next thing. One thing that I like to do, and let's go back to the January 31st expiration. One thing that I like to do, like let's say I think Bank of America is going to be in a channel for maybe even a month, okay? I could sell the 1 month options that expire, February 28th or something like that, and buy the March 7th or March 21st or April 17th. Or you know what I could do? I could sell those really high theta January 31st calls. And then I could buy maybe the February 28th or even March 7th calls. So now you can see I've got the January 31st calls over here, March 7th calls over here. Now I pay a little bit more for this, but I'm going to show you some tricks in just a minute as to how and why this can be an extremely strategic way to trade these going forward in the future. Okay, so let's get back to our thing here. When it comes to option trading, we always need to consider two things. One, how much, three things. One, how much we can make, one, how much we can lose, and another one, the likelihood of winning. So one thing we can do is look at just the absolute risk, which is a profit and loss diagram, and the other is an incremental risk, which is changes in the pricing factors, which is the Greeks. So let's start at the beginning. This is an artist representation of what a profit and loss diagram for a simple time spread would look like. And when I say artist representation, I'm completely lying to you because that's my representation and I did the best I could, but I'm not going to call myself an artist. But it kind of looks like this. Whatever the strike price is, like we were just looking at the 47 calls, was it, right? Yeah, the 47 calls. So this would be the 47 strike. We're doing the 47 strike on both options. So it's a shared strike price. And basically what we really want is for the stock to be at 47 when the short-term option expires. Okay, so this horizontal axis is the underlying stock or ETF at the expiration of the short-term option. Ideally, we want the stock to be at the strike price. If it's below the strike price, then hey, that's good for the option we're selling because it expires worthless at zero, but the option we own, the call we own, gets worth less and less and less. If both options are super far out of the money, they're both worth zero, and we have a maximum loss. But if the stock is above the shared strike price, then what happens? Well, if the stock is above the shared strike price, then both calls are in the money, and the higher the stock goes, the more we lose on the short-term call because it's 100 delta. But the long-term call that we have is not 100 delta. So we're basically losing at 100% and winning at something less than 100%, 50%, 60%, 70%, 80%, until that call gets so far in the money that they're both 100% and it stops the loss and we only lose what we paid for the spread. So that's what I like to call absolute risk, but it's basically what we call a P&L diagram. Now, as far as the Greeks go, and again, if you're new to the Greeks, you're not familiar with delta, gamma, theta, or vega, please go to Firstrade's YouTube channel and review the presentation that I did on the Greeks. So first of all, we have delta, which is the directional sensitivity. That could be positive or negative, meaning it could be better if the stock goes up or better if the stock goes down. Now that sounds weird, right? Well, not really. If the stock is below the shared strike price, it's a positive delta. We need it to go up towards the shared strike price. If the stock is above the shared strike price, we have a negative delta and we need it to go down towards the shared strike price. So it can be positive or negative. And gamma is negative. And that thing we were just looking at, it was a picture of negative gamma, really. That's how much the delta changes. Negative gamma means it always changes against you. If the stock goes down, then our delta gets more negative and we lose more and more money as the stock goes down. If the stock goes higher, if the stock goes down, the delta gets more positive and we lose more and more money as the stock goes down. If the stock goes up, the delta gets more negative. We get like shorter. So we lose more and more the further the stock goes up. Theta is always positive, and I explained why that is just a minute ago, because we're selling a shorter term near the money option that has a higher theta than the longer term one. And the vega is positive, although vega, it's out of the scope of what we're talking about today, but vega is very important in how you select candidates for time spreads. Today we're talking about adjusting, and we need to get to that. And we're going to start talking about rolling time spreads. So when we put on a time spread, we have three different analyses that we need to do. Technical analysis, and we're looking for a stock or ETF that's in a range. Fundamental analysis, and if you're not good at reading financial statements, that's all okay. We're basically just looking for a stock that doesn't have any major news coming out. And then volatility. And here's the big secret. We always want to sell a higher implied volatility on the short call and buy a lower implied volatility on the long call. So if we were to go back to this, let's just go back to our original super easy January 31st, February 7th spreads. If I change this to Greeks and analytical and pulled both of those up, we've got the implied volatility in this column here. So if we were to be selling these 47 calls, we would be selling at 24.33 volatility. And if we're to be buying these February 7th, 47 calls, we would be buying at 22.91 volatility. So this is what's called a volatility edge. Selling a higher volatility than we're buying. And we always prefer to do that. That gives us a little extra profit potential and less loss potential and higher probability of success potential. As far as the month or expiration selection, we generally choose months. You know what? Hold on a second here. I want to change that to make that a little bit more clear. If we're choosing expirations, we generally choose, oops. It is my job to make things as clear and easy for you as possible. So I want to make that change here. We generally choose expirations that are at least 3 expirations apart. Now, I don't always do that. Sometimes if I just am looking at this as a real short-term play, hey, I think it'll stay in this range for 4.5 days. I'll sell the one that expires this Friday and buy the one that expires the next Friday. But there can be some advantages to doing it 3 expirations apart. And then there is continuation versus closure. If we have ones a few expirations apart, we can actually continue the trade. So let's talk about that. Rolling a time spread is closing one leg of the position and opening another leg as a single trade. And what we're doing here with time spreads is rolling out in time. So basically, let's say we we sold the January 31st calls and buy the March 7th calls. Okay, if we do that, then what? Well, what do we do when expiration rolls around? And let's bring this to just regular old calls and puts. If we still like this trade, and let's say we're close to the 47 strike, they're just a little bit out of the money, they're going to be trading for a lot less than they are now, a lot less than 35 bid at 36. So what we could do is we could buy those back at a lower price and then sell the next expiration, the February 7th 47 calls. And they'd be trading, I mean, this is a couple days later, so it would be a little bit less than this, but we'd take in more premium. But we don't do anything with the 47 calls that were long. Now, sure, they decline a little bit in value, but the other ones decline a lot more in value. And you can see that if I go back to the Greeks analytical page here, the theta of the, the theta of the January 31st calls is about 6.5 cents right here. The theta of the February 7th calls is about, or the February 7th 47 calls is about 3.6 cents. Theta of the February 14th 47 calls is 2.7 cents. Theta of, and let's just skip down to the March, the punchline here. The theta of the March 47 calls that we're buying is 2.1 cents. So yes, the ones we own will decline in value, but these shorter term ones are going to decline about 3 times more in value. All right, here. So at expiration of the short-term option, if we are skipping expirations between, we basically have three choices. Whether we made money or lost money, we have the same three choices. One is we could close the trade. If we made money, we could take our profits and we're done. If we lost money, we can cut our losses and we're done. Or if for some reason we do an analysis and we say, you know, I'm not neutral anymore, now I'm bullish, I could just simply buy back the short call. Or or I could just simply let the short call expire and keep the long. Now, honestly, that one I don't like to do that often. Why? Well, because if 3 days ago I was neutral on it, why am I bullish now? If there is a valid reason, then that's a valid way to, that's a valid choice. But there would have to be some new information in the market for me to change my mind like that. Or I could roll the short option to the next expiration and keep the long one. So that would look something like this. Let's say, and there's just a different example here. I wait a second here. Hold on a second. My goodness. Oh, sorry about this. Kind of made a silly mistake here. And I don't like to make mistakes. I don't like to make mistakes when I have to make sure that you are getting super smart with this stuff. It's an important job I have. Okay. So back to this. Oops. One more little issue. Okay. So let's say I was short the January 31st 55 call at 275. Long the February 21st 55 call at 70 cents. So basically bought the spread at 205. So here's what I can do. I can roll by selling. Oh, shit. I don't know how I did that, guys. I could roll by buying the January 31st 55 calls that I was short. And, you know, they're going to be trading a lot less now. Maybe it's 5 cents or something. And then selling the February 7th 55 calls at, you know, wherever they're trading. You know, it doesn't matter. I don't know. It'd probably be something like, I'd probably be able to honestly sell them at about 275 here, because when I sold these, if they had 7 days until expiration, and if it's ideal trade conditions, volatility is about the same number of weeks in an expiration cycle if it's a monthly. If I could sell these 1 week 55 calls at 275, I could probably sell these 1 week 55 calls at 275 too. So then if I did this, I mean, what I'm doing here is I'm basically selling a time spread. I've got a long time spread. I sell a time spread and I end up with a different long time spread. So pretty neat, pretty interesting, isn't it? Um, so Catherine, hello, Catherine, says, is there a disadvantage in buying a leaps call at max expiration and then start selling the short expiration calls, other than the higher initial cost? Um, yes and no, maybe. Like one issue is that you're gonna roll these every expiration. If it's a weekly and you're buying a 2 year option, I mean, you're going to be rolling for 104 weeks. For a stock to be in the, pretty much to stay pretty pinned to a strike price for 2 years, it's pretty rare. So for me, I like to keep them a little bit shorter expiration on the longer term options. I think somebody else's microphone is open here. I like to keep them a little bit shorter term because I mean, I don't know if I've ever seen a stock that's been in the exact same place for 2 years. But I mean, if you did like a double calendar, and it would have to be like a stock that has enough meat on its bones, probably not a 55 strike, but more like a 300 strike or something. Hey, Firstrade, I think your microphone is on. Can you hear me? So, yeah, so like that's the only real problem I see with it. And another problem is that leaps options can be pretty illiquid, like really wide bid ask spreads. So you'd have to really be sure to middle the market. Yeah, if you adjust the short call, I mean, you'll have to adjust the short call every time by definition, right? If you're selling a weekly call. But if you adjust the strike every time, then you do end up with more of a directionally biased trade. Because think about it. If I'm long like the 55 call and short the 65 call, the 55 call is going to have a bigger delta than the 65 call. But if I'm long the 55 call and short the 55 call, they're going to have a pretty similar delta. So, I'm going to end up with a directional bias. I like to, for what you're talking about, Catherine, I like to do that and start out as a diagonal very intentionally on stocks that I think might be able to continue going up over the next couple of years. And then in a perfect world, the way that works out is the stock does go up and I just roll to a successfully higher strike each time. So yeah, I do like the way you're thinking. Joe says, is there a way to search for stocks that are suited for time spreads? I mean, there are different tools out there. I mean, what you need to do is what you need to do is there's not great tools for it. Um, the best way to do it, honestly, the way I would do it, and I don't know how much you're gonna like this answer, but if I go to like, well, let's look at BAC, and I pull up their chart. Remember, I need the stock to be sort of in the middle. I need it to be at that shared strike price at expiration. So in my example, I needed it to be at 47. So if there's support below, which there kind of is, honestly, at about 45.75 or so, and resistance above, which there kind of is, about 47.75, 48, then from a technical standpoint, that's a good stock to choose. I selected Bank of America for this example because their earnings are already out. If they have earnings coming out like tomorrow or something, I wouldn't want to do it either. So those are your two starting points. Just flip through charts. Like if you have a watch list, like I would be like, Okay, Bank of America. Well, yeah, it kind of is in a little bit of a range. Okay, uh, Goldman Sachs. Oops, I guess I got, whoops, holy moly. Here, let me go back up here. Goldman Sachs. That one's not quite in as much of a range, so bad candidate. I would just go through my watch list, look at all the stocks that I typically trade. Um, Visa. Not really in a range. It's up about 10% in the last week. To me, that is the best way to search for these and the easiest way because you can usually eyeball it pretty simply and pretty quickly and effectively. And then once you find stocks that are in a range, find out when their earnings are. And then if you want to be an overachiever, which you should as a trader, you should try and put on the best trade you can, then compare their implied volatilities. All right. So look, if we are buying these, uh, wait a second here. Hold on a second here. Okay. If we are buying these February 21 calls, well, actually, hold on a second. Gosh darn it. If we're buying these March 21 calls and we sell, wherever we start this process, say we start, say February is 7th is this Friday, right? So we buy the March 21 calls, sell the February 7th calls at 70 cents. Okay. Let's say a week passes and we roll. Okay. And I'm making this ideal trade conditions, assuming everything works out perfectly. And then we're going to back off of those ideal assumptions. The stock stays right at the shared strike price. I'm able to buy these calls back at zero, just to make this easy to understand. Then I'll show you a more realistic situation. And I sell and collect another 70 cents on these. Well, I still only paid 275 on these, but now I've collected 70 cents twice. Next expiration works out again exactly perfect. Well, I still only paid 275 on these. They're getting worth less, but that's what I paid for them. But I've collected another 70 cents on these. Next expiration, it works out exactly perfect. Still only paid 275 on these. I didn't touch them. They are worth a little bit less, but that's okay because I've collected a total of 70 times 4 here. I've collected a total of $2.80. I've collected more than I originally paid for the March 21 calls. Even if the March 21 calls were worth zero, heck, I'd still make a nickel. This is sort of like the tipping point. And then anything after that, it's just gravy. It becomes impossible to lose on this whole sequence of trades. So in reality, it doesn't work out perfect. Okay. And it doesn't have to. One of the main realities that doesn't work out perfect like this is we can't buy it back at zero, but we could buy it back at a nickel. And all that does is reduce the aggregate premiums by a nickel each time. I mean, here we're still almost at break even, just a nickel shy. Or maybe I have to buy these back at more. Maybe I have to buy them back at 60 cents. And then I'm able to sell these at 90 cents because the stock's higher. It still works. I'm using ideal trade conditions because it makes it very easy to understand, but it's never going to be ideal and it doesn't have to be ideal. Okay, let's talk about legging into a double calendar. So, double calendar is when we buy one call in month A, sell another with the same strike price, but a different expiration in month B or expiration B, and then buy a put at the same strike, but different from the put, uh, but a different expiration in month B. So it's easier if we just take a look at this. So basically, what we'd really be doing here is because, and we'll just look at the, well, we'll look at a 2 week one. No, wait, get rid of that, get rid of that. We'll look at it. We'll look at a 3 week one. Why not? Because we're like kind of right between two strikes, I could do the 47 strike call time spread, sell that at 62 cents, and then I could do the 46 and a half put time spread and also sell that one at 23 cents. Now, if I do that, I end up with something, hold on a second here, that looks more like this. Okay. But let's say I'm going to start out with the call time spread. I'm going to start out with something that looks like this. Uh, Hold on a second. Okay. So let's just say here that I start out with this time spread. I sell the January 31st, 55 calls, buy the February 7th, 55 calls. Um, because I obviously I'm thinking the stock's going to stay around 55 until, well, really until January 31st expiration. So what if it falls to say like 51? Well, I got to do some damage control. Um, is there new news that came out that makes me adjust my forecast? If not, you know, then that's okay. Maybe maybe I expect a retracement or what some traders will call a dead cat bounce. Sorry for the cat lovers out there, but that's just an option or a trading term where the stock falls and uh, so if I think that it might retrace a little bit or just sort of stay there, um, I might leg into a double calendar. So my original trade is this. Um, I'm down a little bit of money on it, right? Because if the stock went lower, the value of both of these calls went lower. So I'm down a little bit. But what if I sell the 50 calls or put? I mean, actually, I'll tell you what, it's better if I do the puts to tell you the truth. So let me change that. You could do either, but um yeah, you could really do either. But let's yeah, this is a nicer example. Oh boy, you're gonna like this one a lot better. Okay. So I started out with, what did I start out with? This trade, down a little bit of money on it. But what I do instead is I just add another time spread closer to where the stock is trading now. In fact, a little further below. We're assuming it's trading 51. We're going to do the 50. So we're going to pay another $1.40. What were we down on this? Oh, we're down whatever we were down. Take in another $1.40. So the new spread is like the bottom one is still the original stuff at the original prices we put it on, but the top is the new put spread that we just bought. So if the stock stays between basically the two strike prices, here's what happens. We go from a trade that looks like this to a trade that looks like this. We have a little bit more room to the downside, but remember, we're not bearish. We're thinking that it's probably going to stay pretty well where it is or go higher. And if it does, we end up changing a stock that was, or a trade that was likely to lose money into a trade that's now likely to make money, right? Does that all make sense? Here, let me take a look at something here. I got one more. Yeah, all right, Catherine. I love it. I love it. Glad. Very, very glad. um, Hold on a second. I just want to make this one match the other one. Mm-hmm. And oops. Yeah. Hold on. Mm. And 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 okay. Now this will be a lot easier to read. So the Jan 31st expiration trade, I say cost, but it's really the credit I received on those. A total of $6. Now the Jan 31st trade. Oops, hold on a second. Uh, there we go. Jeez Louise. Okay. So this is how you know if it's really worth it. We took in a credit of $6 on both of these. And, we did the Jan 55 calls maybe yesterday or the day before. We did the 50 puts after that. This was the trade we legged in, part of the trade we legged into. The current price is this. So we actually lost a total of $1.40 on this. And you can think about this as a strangle. When you're looking at double calendars, you can look at it as a strangle. So at January 31st expiration, assuming the stock stays stable and is still around like 51 or whatever, this is going to lose. Oh, hold on a second. Actually, I'm making a silly mistake. Okay, 1 second here. All right. So sorry about that. I had a typo on here. So if I originally I collected $6, right? Because I sold these. Now they're worth 460. I'm actually would have made $1.40 on these, right? um, and these right here at January expiration, I actually would have made just a little bit more. So it's really, I balanced that against what I lost on the February strangle. Um, that slide got a little bit goofed up, which is not like me. And I apologize about that. So let's just move on that. And why don't you hit me up with a couple of questions here and I can go live into the platform. I can go live into the platform and just, show you some kind of live real examples if you have any further questions. Do you have any further questions? Any further questions? How much does the overall market influence that? Oh boy, now I love that you asked that question because I'm actually in the process of trading some time spreads as we speak. They're earnings trading time spreads, which are very different than what we're talking about here. And the overall market, if we're just fluctuating within like a 0.5% on the S&P 500, it's not going to influence it that much. But if we move more than that, the stocks will trade in sympathy with the broad market because all stocks have a beta. And if from my observations, if the fluctuations in the underlying market are small, the underlying stock might not even trade with that beta very much. Market could go down, the stock could go up. But if the market's down like 1.5%, most stocks are going to be down like 1.5%. So yeah, as far as Fed meetings and such go, I am a lot more cautious when it comes to putting on any short premium trade going into a Fed announcement, just because there's just frankly a lot more risk. So okay, well that is all I have to say. Oh wait, what about a time spread on the SPX, assuming it's a bull market? Yeah, so if you assume, okay, so if your expectation is that it's the broad market is going to go up, the SPX is going to go up, you can still do a time spread, but you would want to do a directional time spread. So like if the S&P 500 is at 6,000, you think it's going to go to 620 or yeah, say 620, you would do the 620 time spread because think about that P&L diagram. Where do you want the stock to be at the expiration of the short option? You want it to be at that shared strike price. Now there is, this presentation was not about directional time spreads. That would be another one. I should probably plan that for my next batch. The nice thing about directional time spreads is you can often buy them a lot cheaper than buying a call or buying a debit spread. And if there's like a volatility skew, where you can sell the higher volatility than buy the lower volatility, you can have an excellent risk reward with an extra edge on that trade. So yeah, very great question, Aslam. Thank you. You always ask really good questions. All right, folks, that being said, have a great rest of your day. Trade smart, and I will catch you next time. Make plans to see me next Tuesday. Bye.